Hello everyone, hope you're all doing well and welcome back to the Baking Analyst channel. On this channel, we cover everything from cryptocurrencies to economics to personal finance with a focus on yield farming and DeFi as a potential wealth generation tool. Well, not in the case of this graph today because I just lost 10k in yield farming and we'll find out a bit more about how that happened and what went down in the past 48 hours. But if the world of DeFi and crypto, as well as passive income, is something that you would like to learn more about, then do consider leaving a like and subscribing to this channel. If you're completely new to DeFi and you're wondering how on earth these people are staking pairs of cryptocurrencies on decentralized protocols and earning a decent sum of passive income every single day, then I actually have a free online course that you can access using a free trial to Skillshare using a link down below. I'll also be uploading a revamped version of that onto our Discord server so that it is free to all. Link again is down in the description below. If you would also like to see some of my picks on some yield farms catered to each risk level, then I have left that in the pinned comment and the description as well. So with that shilling off the way, let's jump right into today's video. Today's video is going to address what on earth just happened in the last 48 hours to Meerkat Finance, as well as going into a look at the truth about impermanent loss, as well as how impermanent loss can actually help protect or even save your portfolio to some extent. So let's jump right into today's content. First of all, let's talk about the obvious. How on earth did I lose 10k in DeFi and what exactly happened? Well, what happened was, you're seeing it on the screen right now actually, but if we zoom out and go into the 1 hour or the 4 hour, you can get a slightly better idea. So one of the favorite pools of many of us Kronos chain users has been the Meerkat Finance ecosystem. And one of the main tokens, the one with the highest liquidity, is the MMF token. And what has happened over the last few days from the 7th of April all the way till today is that MMF has been going in free fall with little to back it up, cascading sell-offs and very little relief. We went to an all-time high of around $1.80. To be fair, we should have seen it coming that it was in pretty overbought territory when it was all the way up here, and then it all came crashing down. Now, to put things in perspective, this takes us back to the prices that we saw all the way back in the early stages of March. And while this channel is not about speculating on price movements, it is completely normal that one would be worried by such a close to 70% drop. So essentially what happened was, part of my farm was in the MMF USDT pool, and then that got hit because MMF started tanking. So instead of turning this into a rant about the price action and possible whale manipulation and all that usual stuff when this kind of thing happens, I thought I would turn this video into an educational session on impermanent loss and how it's really been reviled more than it should be in the DeFi space because it can potentially mitigate the losses. What I was farming was not MMF Rat Crow, it was instead MMF USDT, meaning that there was a buffer of 50% USDT in order to absorb the losses. And as you can see, that dump is continuing to happen. We are just looking at this go down, down, and down. So that is of utmost importance that we know how to make use of impermanent loss to our advantage. So the first point about impermanent loss is that it is less scary than it sounds, right? So impermanent loss really is more of an opportunity cost in terms of getting back a smaller number of underlying tokens than you went in with. A lot of people see this as a loss, or rather a contributor to underperformance in a portfolio when the market is rising, especially if you pair an unstable coin to a stable coin, because as the price of the token goes up, the pool keeps rebalancing its assets to a 50-50 value ratio, meaning that the appreciating asset is continuously sold off to purchase the stablecoin, leading to overall lower gains. However, looking at this scenario where MMF has dumped close to 70% and now is sitting at under 70 cents, we can see how this can be used to your advantage and how this can be used as a risk management strategy. I've covered this before in a separate video, and this is the concept of reduced volatility pairs. And the concept is by pairing your volatile token such as CRO, or in this case indeed MMF, with USDC or USDT for instance, then your exposure to the volatile coin is limited to some some extent, or at the intensive margin as we call it. And what I mean by this is if prices fluctuate within a narrow range and it doesn't just fall straight to zero, then your losses are likely to be limited to a great extent because of the fact that you have paired your coin with USDT or USDC. And I'm not going to go into the exact math of this. You can find this online. There's like a whole graph that illustrates your P&L based on the drawdowns. Essentially what you need to know is when you reach a loss of 80 to 90%, you know what, it makes very little difference because most of your stablecoin has been sold off to buy the unstable token. But let's illustrate it using this diagram again, just for those of you who may not have been around when that video came out. So let's say, for example, that CRO were to fall a certain amount, and of course this is a very gross oversimplification. Now, when the price of CRO in the market falls, you can see that the value of the CRO in the pool is diminished. However, what happens is that an automated market maker works by rebalancing the pool to a set ratio in terms of dollar value of the two tokens. Arbitragers or traders come in to balance the pool because they find that the price of CRO in this pool is higher than that of the open market. And what happens is part of the USDC in the pool is then sold off to buy CRO, and then you see that the ultimate loss to the overall portfolio is given by the unshaded area in the dotted rectangle over here. And yes, you know what, that is still a drawdown, but it could be worse. If you had just held on to CRO or one token or even MMF, you would have taken the full 70% or whatever percent loss that particular volatile token has fallen by. And in this regard, while yes, you are losing out in terms of the fact that you are getting less USDT at the end of the day out of it, you're still better off than just holding it all as a maxi. The whole point of today's video is to get the message out there that impermanent loss is not as scary as what a lot of newcomers to DeFi might think it is. Simply because it contains the word loss in its name doesn't mean that you cannot use it to your advantage and help protect your portfolio. While the downside scenario of impermanent loss comes from people expecting prices of the underlying token to go up, we also have to realize that when times are good, that is the time to be protecting your portfolio and coming up with the exit strategies and not waiting until whatever risk has already happened. So the final question is, of course, what do I think about the recent price action of MMF and what am I going to do about it? That is a question that has been asked quite a bit in my Discord channel, which you can join using the link down below. Once again, there were actually two distinct phases to the crash. There was the first crash that took MMF all the way down to around 90 cents. The thing is, I moved more money into the MMF USDT pool at when the prices of MMF were around 90 to $1. So I set that as a line in the sand to say, okay, I might be overexposed to MMF, and if it falls to that level, I can at least take out that 10k that I've moved into MMF back sometime in March and keep the profits from farming using that capital and move that back to something like Dark, which has proven to hold its peg relatively well and which has a clearly defined exit strategy. However, I'm still keeping some position in the MMF USDT pools simply because there are few other alternatives that offer similarly high rates with sound tokenomics. Overall, I think that the fundamentals of the project haven't changed a lot. In fact, the Meerkat team has just announced that they will be launching a stablecoin swap, much like Dark, so that could increase buying pressure for MMF somewhat. Not financial advice, that could completely not happen. And of course, during times like these, it is natural for people to be asking, you have an exit strategy for Dark, how do you come up with an exit strategy for MMF, and when do you know that it is completely done? Well, the fundamentals of the project remain intact in terms of the team. However, that has little bearing whatsoever on the instantaneous value that investors place on the ecosystem tokens. And so a lot of the value of these tokens are really based on faith and belief in the project. So what could be an indicator of continued loss of faith in the project and people simply throwing in a towel, getting out and giving up on MMF? One way I think we could look at it is to go over to METF, and METF is actually backed by a lot of MMF tokens, some Savannah tokens or SVN, as well as MMO and some CRO. So right now, as you can see, confidence in the ecosystem is definitely not very high, and it reflects in the numbers. And what do I mean? Well, the backing per METF token currently is $71, whereas the price is at $69.81. Now, what does this mean? This means that METF is actually trading at a discount to the value of the assets held to back it. And so if METF remains below the backing per METF for a prolonged period of time, you can perhaps set yourself a week or even 2 weeks, depending on your views on the situation. If it stays below peg, you can interpret this as the free market deciding that, all this stuff that is backing the METF token is not worth its current value, meaning that, people are likely to be just flowing out of the ecosystem. People are getting out of METF and losing belief in the ecosystem in general. And all in all, while the losses have been painful, we need to remember that as yield farmers with high APRs, we are still likely to be better off than we were at the beginning of March, for example. Even with the current dip, I am still up over more than 5 figures since the 1st of March, according to my spreadsheet. But in any case, I think that even though this has been an unfortunate event, it has been a good stress test of many of our portfolios in order for us to look at this and reassess whether we are assuming the right amount of risk for our appetite. So I hope this video has been informative and useful. If you liked it, do leave a like down below and consider subscribing to this channel. And with that being said, thanks for watching and I'll see you in the next one.